So the big question still is whether the banking crisis has ended or whether this is just a cessation in a much longer battle. Nathan Zaia is a senior equity analyst with Morningstar who covers the banking and insurance sectors and joins me now. Nathan, as always, many thanks for your time. What's your own gut feel about this? There's calm today, but quite clearly, when these things sort of emerge, it sort of tends to bubble up in different places, doesn't it?
Yeah, Ross. Yeah, I definitely don't think it's over by any means. I think we've probably seen two institutions that have succumbed to the rate tightening cycle, and I'm sure there's going to be others that have not matched the risk on their assets and liabilities appropriately as we go through this period. And we've seen how quickly those deposits can leave as well. And I think it's not just about the short-term liquidity issues they might have. It's longer-term, what sort of profitability or how profitable can some of these banks be going forward? And then, we just could see more and more look like they're in dicey positions, and that just leads to less confidence and more deposits leaving the system. So I think it's, everyone's doing the right thing to try and restore confidence. But I think it's way too early to call this the end.
But Nathan, this is an unusual bank crisis because this is about, as you say, the mismatching of assets where long-dated government bonds or investments become worth less as interest rates rise. Normally when interest rates rise, it's because of credit risks suddenly coming home to roost to banks that make them shaky. That's not the case, at least yet anyway.
Yeah, not yet. So that is the thing. We might see that credit risk and defaults start to come through as well. But you're definitely right. That is not what is bringing those global banks unstuck at the moment. And that's why we don't think we'll see a similar thing here in Australia. Just there's a few differences. The first one's the regulatory oversight, the liquidity, capital and funding ratios that our Australian banks adhere to are very strict. Their deposit funding, a lot of it is retail, which does tend to be a lot stickier. Some of these banks that have been in trouble, very concentrated deposit funding, so you don't have that risk of it leaving so quickly. And I think one of the key big differences is the Australian banks, they're focused on using deposits to lend and make money, and they're very profitable at doing so. So I think that also gives deposit holders confidence when they see banks are making 7 billion, 10 billion a year. That gives you some comfort that my money's probably safe in those institutions as well.
And the other thing also is Australian banks have almost been through the furnace, been through the fire with the, Banking Royal Commission, and before that, the Financial System Inquiry, to make certain that banks were unquestionably strong in the first case, and then in the Royal Commission, trying to really address the riskier parts of bank behaviour.
Yeah, I think that's right. So we've seen the regulator really increase the capital requirements and how they approach risk. I think post-Royal Commission, they have simplified their businesses as well. And so it's easier to manage some of these risks when you are smaller and more focused.
So one of the other risks potentially that could happen here in Australia could very well be a liquidity problem, and that is the inability for Australian banks, particularly smaller institutions, to gain access to liquidity, especially from overseas if it dries up. That's one of the reasons why central banks right now are pumping so much money into the system to make certain that liquidity does not dry up.
Yeah, that's right. And the big risk, I think, for the Australian banks, I think they still would be able to access funding markets, given the quality of the names we're talking about, but it might get a little bit more expensive. And if that happens, it just puts more pressure on deposit pricing, so how much they're willing to pay for deposits. And then, I think that hurts the smaller lenders more because they're more reliant on those term deposits as well. So a few things could play out. And I think one thing we shouldn't ignore is how much of their loans are variable as well. So the banks could turn to that lever in increasing lending prices to try and offset some of those margin pressures that might come through.
Okay, so we've seen so far that much of the crisis has been on small to medium-sized US banks, plus one bank that was already wounded in Credit Suisse. The question is whether it can pop out in other areas, in the non-banking finance sector, or whether it can pop out in the insurance sector, because certainly that's what took place in the banking crisis in 2008, especially with AIG, for example. So can you see that there are risks in other sectors that might be affected?
Yeah, I think that is definitely true. The insurance would be one of the key ones, because they do take policyholder funds and shareholder funds and invest them, in bonds and various fixed income products to generate a return. So whether they, got some of their money in bonds that are now worthless or worth pennies in the dollar, that definitely could be a risk. But they generally are pretty diversified. So I don't see it as being a major risk for our local insurers in terms of needing to raise capital. But yeah, it definitely is something we don't have full disclosure on, or a full line of sight on.
I'll tell you what, Nathan, always great to chat to you. Nathan Zaia is the insurance and banking analyst at Morningstar, and many thanks for your time today.
Thanks, Ross. Pleasure.